Hey everyone! With the final month of 2023 fast approaching, the Marcus & Millichap research team is hard at work on the 2024 commercial real estate investment forecast books. Personally, in my 17 years of leading the production of these outlooks, the 2024 forecast is shaping up to be one of the most complex we've ever done. This year, there are countless crosscurrents influencing the economy and each of the 6 commercial real estate property types covered in the forecast books. The 2024 Canada Investment Forecast will come out first at the ICSC Whistler event in British Columbia. And as in the past, the 2024 U.S. Multifamily Investment Forecast will be released at the NMHC Strategies Conference at the end of January. But for now, I want to share a quick snapshot on where each of the property types stood at the end of the third quarter, the most current data available. And I'll highlight some of the key drivers investors should monitor as they look forward into 2024. I'll cover 3 properties this week, then 3 more next week. And I'll start with industrial. As of the third quarter, the industrial vacancy rate nationally was 4.8%, which is up 120 basis points from a year prior, with annual rent growth of 9.5%. And although absorption on a national level has been positive every quarter since 2010, it has tapered over the course of the last year, and rent growth has followed suit. In addition, we continue to face record construction levels, with 400 million square feet expected to come online in 2023. That said, about half of the completions in 2023 will be in 9 metros: Dallas, Riverside, San Bernardino, Chicago, Atlanta, Houston, Phoenix, Indianapolis, Philadelphia, and Charlotte. Looking ahead, investors should monitor local construction and watch for rising vacancy rates. Overall, demand for industrial space should remain positive in 2024, but much will depend on whether the Fed successfully achieves a soft landing. Next up, multifamily. Apartment properties also face significant supply risk in 2024. As of the third quarter, the multifamily vacancy rate was 5.4%, up 130 basis points from the third quarter last year. Rent growth on a national level tapered significantly over the last year, with effective rents up just 1.7% from the third quarter of 2022. Apartment demand has been positive every quarter this year, but it has fallen short of the record pace of deliveries. About 420,000 new units will be completed in 2023. We do expect construction to rise even further in 2024, which will continue to place upward pressure on vacancy rates in most markets. Investors should monitor these trends on a local level, but investors should also look more deeply into the pipeline of development beyond 2024. At this point, it looks like the pace of construction should thin significantly in 2025 and beyond. As a result, even markets with a lot of new units coming online in 2023 and 2024 could ultimately outperform if the economic drivers in that market, particularly job creation, remain robust. The third property I'm going to focus on this week could also face new supply challenges, and that's self-storage. As of the third quarter, the average national self-storage vacancy rate was 8.6%. up 110 basis points on a year-over-year basis, while street rents were down 4.5% compared to last year. Storage rents are one of the factors that are complicating the 2024 investment forecast. Street rates have fallen, but the effective rents for existing tenants remains relatively stable. This is tied to the ECRI, or the existing customer rent increases. The majority of the self-storage operators have been reducing the rates at which they market their units, the street rates. Then they gradually raise the rates over time to get back to their target effective rate. Unlike apartments, where there may be some concessions such as 1 month free on a 12-month lease, self-storage isn't tied to an extended lease. So storage operators can migrate rents up to their target rate after the tenant has moved in. That said, rising vacancy rates could become a significant headwind for the sector. An influx of self-storage development is in the pipeline, but the big question will be whether all of the development will actually be finished. Because of the higher cost of capital and construction costs, a lot of the storage projects could be shelved, but investors will still need to monitor their local construction risk in 2024 and beyond. Next week, I'll highlight the key trends affecting the office, retail, and the hospitality markets. Then watch for the 2024 Commercial Real Estate Investment Forecast, a fantastic resource to help you keep your eyes on the horizon.